Day 30, day 30. Jesus, there you are. Day 30. How are you guys doing today?
All right. Living a dream.
Living the dream, living La Vida Loca.
Yeah, it's gotten better. I got some stuff done yesterday.
Living La Vida Loca. It is overcast, hazy, 80% chance of rain today here in South Texas, but it's comfortable. It's like in the mid 60s. So, anyway, so today is Nina's going to present to us this deferred income thing. And why it's of interest to us is when you're dealing with a seller that has a potential high tax liability from their capital gains, they've got a couple of options, and this is one of them. And so, they have the option of selling and then taking the money and paying the taxes from the capital gains. They have the option of doing an owner finance and taking parts of the money over the term of the finance. And then they have the option of 1031 exchange, going into a property of equal or greater value than the one they just sold out of. And then they have this option, which is taking the money and setting it into an account with I'm going to call it a custodian right now. You can give me the terminology better when you present it, but with a custodian that defers the money and pays it out of an escrow account over a term as set by the seller. Again,
not quite that, but I'll clarify.
Okay, that's my caveman understanding of it. Okay,
Yeah.
But again, the idea is to defer their tax liability over a period of time, and it's set up with their tax professional, and the term is determined. So, the objective here is this is one of those tools that we need to be aware of in order to help our seller and to help ourselves in the acquisition of a property.
Right.
Drum roll, Nina, you're up. Curtain open. There's your entrance. There's the music. Da-da-da-da. You're
Okay.
on. Tell us about it. What is it called? Yeah, what is it called?
I call it intermediary installment sale. Now, the presentation I have, because it's easier to show you with the visuals and stuff, because of how it's structured, it's what I usually will present to sellers when I'm going to do a listing. And I let, especially if I've advertised it that way. If I'm doing my direct mail to say, hey, save your capital gains taxes, defer your capital gains taxes, and then they're calling me and I go for the listing appointment, I tell them about this in order for them to see the advantage. Because a lot of sellers, they don't want to sell their property because they've got the capital gains implication. And they don't know, a lot of people don't know how this works because it can be complicated. You need several parties to be involved in it to make it work. And you also need the right dealer, what's referred to as a dealer. So the intermediary buyer is essentially a dealer who is not a broker, not a loan broker, not a real estate broker. They are a buyer who is facilitating the sale of the installment sale with their identified lender. And there's very few lenders out there that do this, very, very few. And some who do it, they won't do it for the high levels that this particular intermediary hit. The minimum proceeds that you have to have on a sale is $500,000. And there's no maximum, but when it hits the 5 million mark, if you're going to be getting 5 million in your proceeds, and that's after expenses of sale, then there is some interest you have to pay to the IRS because of that excess. But that gets into the weeds. That's not the simple version. One thing I do want to clarify, though, is that when Paul was saying, the seller takes their proceeds and dumps them into account, they don't. The whole benefit of the installment sale. So let's say, Mark, you have a property and it's $2 million and you've got a loan on the property for $500,000. So you're going to sell it and your net after expenses is going to be about 1.4, Yeah, 1.4, after expenses. We'll just go with that number. That 1.4 net that you're going to get, you have to pay capital gains on 30 to 40%. You don't want to sell. I can't hear you. You're muted.
If that's my gain on the sale, okay.
Yeah. So you don't want to pay 30 to 40%. I mean, that's a big chunk of your proceeds. So you're going to wait, but you want to sell because you want to get out of that asset. Maybe you're a landlord who's tired of being in the business. It's a challenge. You want to move into something else. You want to move into another state. You have a new opportunity to move into something. That's where you have the most capital that you can liquidate through a sale. So, sorry, I have to turn off my phone. My father is in the hospital, and it's this craziness with my family is texting like back and forth. Okay, sorry about that. So,
Can I ask questions along the way?
yeah, absolutely. But let me just clarify this one piece. So you have the 1.4 is your proceeds, but 30 to 40% of that's going to go to capital gains tax. Well, you don't want to sell. So you're kind of in a catch-22. You need to sell to get into this better opportunity, but you can't because you're going to end up losing 30 to 40%. Well, actually you can. And so you have to then, when you do the installment sale, you're not taking those funds and putting them into an account. You get to keep your proceeds. You get to keep, and I had to look it up. They updated it. You get to keep 93% after seller expenses. You get to keep 93% of that 1.4. So now you can go and invest that wherever you want and do what you want with it. That's the advantage to investors and to, if you're trying to acquire a deal too, you can present it to the seller. But the advantage to you as an investor, if you own property and you're trying to get into other deals, you can be your own bank by doing an installment sale. So I'll show you how it works. So go ahead, Paul, if you have a question.
Okay, so now I have two questions. So the dealer, who is the dealer?
The dealer is an intermediary buyer. They're not a loan broker. They're not and I'm not going to name them because the only way I can name them is if you're doing a transaction. So,
okay, so we have Mark the seller.
Mm-hmm.
We have Jesus the buyer.
Mm-hmm.
Mark's going to get a $1.4 million net gain on his property in your
Mm-hmm.
example.
Mm-hmm.
And he contacts Brad, the dealer.
No, he contacts me.
Oh, well, okay, you're the dealer. Yeah, I just.
Nope.
Right.
I'll show you. Let me show you the visual because it's easier to see the visual.
Okay, and then tell me where the 93% comes in, because what I heard is that he gets to keep his 93% of a 1.4, or the 93% goes into this fund.
No, there's no fund that it goes into. So let's
or
get
escrow or whatever. Okay, go ahead and show us
there's
your
no
graph,
money.
right?
Your funds are not going into your funds are going to you. So you're not
Like literally into your bank account?
Exactly.
Okay, I'll wait for the graph. You got a graph for me?
Yep, I'm going to show you. So.
Well,
okay, can you see my screen?
Not yet. Yeah.
Yes.
When you say your account ruled by somebody else, right? Like managed by somebody else.
No.
Because if it's your account, the IRS is going to say that there's your money. I got to take your 35%.
That's my question.
And that's not how it works.
All right, let's.
It's intermediary with a lender. So let me explain it to you. Okay. So just before I explain it, and I have to do this, it's just a protective thing. The intermediary buyer wants to make sure that we do this. I'm not a tax advisor. I'm not a legal advisor. This is a recommendation. You can choose to take it if you want. Should you open a transaction, and I'll explain what that means, and you close that transaction, the intermediary buyer does pay me a fee of 1.5% of the transaction. And that's just, and they're paying it. The seller doesn't. And then this is all confidential. I will share the PDF with you guys, but it is confidential, so you can't send it around to everybody. If you have somebody who wants to do one of these, just introduce them to me. We'll get on a conference call and I'll explain it to them. Okay, so.
Is that 1.5 of the net proceeds or of the sale?
1.5 of the sale. And that you don't pay that. That's what the intermediary buyer pays.
got it. Yeah. Okay.
Okay, so you don't even have to, as the seller, you don't have to even worry about that. That's just what they pay us to bring it to them.
Okay.
Okay, so in a traditional sale, we all know that there's the seller, there's the buyer, there's the seller, it goes through title. And what happens is when the seller's funds are received, or we see that on the escrow statement or the closing statement, that is referred to as constructive receipt with the IRS. And that's what triggers the tax. Okay, so that 1.4 that Mark's gotten is what's going to trigger the tax. But then you have a problem, the 30-40% that goes to those taxes. The solution that most sellers take is the 1031 exchange. But the 1031 exchange, and Paul talked to us about it yesterday, requires first that the seller uses all of those proceeds to purchase a like-kind asset. And then there are other specific requirements.
You blinked out right there. There are other what? Requirements? What?
Other specific requirements for a 1031.
Mm-hmm.
The first is 45 days after the close sale of the asset, the seller has to find a replacement. So that's just 45 days. So that's 6 weeks. You find a replacement, and then that's within, and then you have 180 days after the close of sale to close on that found asset. So that means the 45 days are within the 180. So you'll only have 135 days left to close on your found asset. There's another piece, and it's part of why they fail. They can't find the deal. They can't, you get into a deal, you find it, let's say you find 3, and that's usually what I recommend is you find at least 3 that you can play with. You open escrow, and then all of a sudden something, you go through your phases, it falls out of escrow. So now you're still in the 180-day timeline. So now you're scrambling to get another like-kind asset because you don't have as much time left to get closed. And that's a big part of why they fail. The other piece that's required is the replacement of the value of the debt. And this confuses a lot of people. And what that means is you had a $500,000 debt on that property, right? When you get into your new asset, you have to replace that same value of $500,000 in that acquisition. And that comes either with taking your 1.4 and adding $500,000 cash to that to buy your new asset, or taking your 1.4, buying your asset and leveraging $500,000 or more for your debt, or both. So you could take $250,000 in cash, add it to your 1.4 cash, invest, and then get a loan for $250,000. You've met the value of the previous debt to be able to get this new 1031. Does that make sense?
Yes.
Okay. Any questions on that?
Nope.
Okay.
Yeah, that classification of property is not a thing here. It's just that you have property. Is that correct? In other words, you can go from house to apartment. You can go from house to apartment to mini storage, those kinds of things.
Yeah. The like kind, for clarification, is it really means it's utility.
Yeah, I had a farmer sell a farm and then they bought a Starbucks in the B of A building.
Yeah. And there's and in the utility of that, it's business, it's revenue generating. It can house a business. So there is a like kind utility there. So that's really what it means, is that you're able to utilize it in a like kind way. And so it doesn't have to be exact for exact type of property. So that's 1031, but of course, and that's the solution, the most common solution to avoid 30 to 40%, but you aren't getting any of your money. You're just moving it over to another asset. Most investors will do this to get out of the current type of asset they're in because of however they're dealing with. There's a motivation there within that's not working for them, that they want to move to another one. Oftentimes it can be if it's not producing enough income, or they have another opportunity they want to get into, or they're getting older and they don't want to deal with being a landlord anymore. So that's that one. But then you have intermediary installment sale, where you can keep, and I have 95%, you know, it's really more like 93% after seller expenses of the sale. So in intermediary installment sale, Paul, you had said that Mark is the seller and he's selling to Jesus, the buyer. So that's your contract, your purchase and sale agreement. But with the intermediary installment sale, we bring in the intermediary buyer. And the intermediary buyer, essentially it's treated like a double close. They close on the same day. And in order to do the installment sale, the whole meaning of installment is there's a loan that, yes, the seller is getting that's unsecured, that is being used by the intermediary buyer to do their transaction of the purchase so that they can resell it to Jesus. And so this is the map of what it looks like. So there's the picture. So you have the seller. They're selling that's Mark. He's selling his property. He gets connected through me to work with the intermediary buyer and the private lender who secures on, who provides a loan to Mark that's unsecured based on the value of his net proceeds. And then the intermediary buyer in the transaction through title and escrow and closing, they treat it like a 1031 because that's what the closing companies understand. Most of them don't get the installment sale. So the intermediary buyer, he goes ahead and says, okay, I'm going to resell the property to Jesus at the same time that I've gotten the funds from the lender. And then we're going to close everything. And once it closes, the transaction with Jesus closes, that's when the installment sale essentially becomes true. And who pays the installment sale? The intermediary buyer. They're making the payments on the installment loan. The proceeds of the loan, that's here, the seller receives, and this is with my intermediary, the seller receives 93% of loan proceeds, not sale proceeds. Because again, it's not the sale of the property, because that would be the proceeds, because that would be constructive receipt. So what they're getting are loan proceeds. And as a result of those loan proceeds, which are equivalent to the sale proceeds after expenses, is upfront cash at the close of the sale to the seller. So you end up getting, Mark, your 1.4. Now you're going to go talk to Paul and say, hey, Paul, you got a deal for me. Now you're going to go buy that boat. Now you're going to go and take some travel around the world. You can do whatever you want because you got your cash. It's not sitting in a property. It's now deferred for 30 years. So it's a 30-year constructive receipt with the lender. And the constructive receipt doesn't occur until the final payment at the end of 30 years because you haven't received it all. Because on paper, it's a loan. It was returned to you as a loan proceeds. And so it essentially postpones the constructive receipt. And there's no money you're paying down for the loan. It's interest only. And again, you're not making the payments. The intermediary buyer is making the payments because it's treated like kind of like seller financing. It's not amortizing, and you get your proceeds from the loan. I mean, you're not having to worry about paying any tax on it now. Your heirs will have to pay tax on it. In 30 years, it's going to be due. The tax will be due. You're deferring it. But if you've got 1.4 million that's cash, you now can go and do some more investing to make more money that will cover the cost of that tax debt in 30 years. So there's a way to leverage your proceeds from sale through an installment sale in order to pay the tax you would have paid if you just received the proceeds in a standard sale. And then these are the steps of it.
Can you go back to the previous screen?
Sure.
I have a question or two.
Sure. Oops. Oh, that's the steps. There we go.
Okay, so seller Mark gets 95% of his, or 93% of his loan proceeds, which is equivalent to the sale proceeds.
Mm-hmm.
That's a disconnect for me. I don't understand that. So in other words, if does he get his 1.4 million?
Let's say the 1.4 million represents
That's his net profit.
that's his net between the sale from him, the purchase agreement is for the $2 million sale price.
Mm-hmm.
500,000 has to go to the debt that's on his mortgage.
Mm-hmm. Mm-hmm. Mm-hmm.
And then he's going to be paying fees to, broker fees and closing costs. So let's say his total net is 1.4.
Mm-hmm.
That's the standard sale.
Mm-hmm.
So if his standard net is 1.4, he'll get 93% of that as loan proceeds, because the way it's written up, he's the one getting the loan, which is the installment sale. So one way to think of it is as the intermediary buyer is purchasing the property from him in an installment payment, as if he were doing seller finance. But the seller is the one taking out the loan on paper, and the intermediary buyer is the one paying the loan.
Okay, I understand that. Does he get is his tax base that that amount that's 1/30th of the loan? Every year is his tax base 1/30th of the loan?
No, the tax basis is from the time it's grandfathered, it's from the time of sale. And it never.
But each year, if he receives 1/30th of the, I'm using that randomly, right? If
Right.
it's a 30-year loan, if he's receiving 1/30th of the proceeds,
Mhm.
is he taxed each year on that 1/30th?
No,
You
because
said he's taxed at the end on the 1.4 million?
right, because and it's not there's not additional interest he's paying on that. He's just taxed based on constructive receipt at the time of sale, but it doesn't occur until the 30 years.
I
So
understand that.
paying any tax until that 30-year period comes,
Mm-hmm.
and it's only based on the time, the date of the original sale.
At any time in that 30 years, can he choose to take the money early?
Oh yeah, you can pay it out. You can definitely get it paid off early. Absolutely, you can certainly do that. You're just going to be paying the tax on it.
Okay.
Yeah, then he has to pay the tax at that time.
When he takes it. How about can at any time can it be used for 1031 purposes? Can it be 1031 into another property?
Yeah, I mean, if you were to take, yeah, you probably could. Yeah, I would say you could. That would be a deeper question to talk to once you go through the process, you have to have a conference call with the intermediary buyer.
Mm-hmm.
I don't believe so, but we'll check.
Yeah.
How about can it be put into an opportunity zone at some point in the future?
So if you're basically seeing it as just, can I reinvest those dollars? Let's say in 10 years, can someone please? Getting feedback. Hey,
Whoever
Jesus,
that is,
thank you.
Wait,
thank you. Everybody mute.
Still feedback.
Who's not on mute?
Sorry, it was my bad. My computer froze, so I switched to my phone.
Okay, I think it's because I'm showing you're on twice. You have your phone and your computer on. Okay, well, there's an echo. Anyway, so if in 10 years, this is not. Hey, Mark, I think you have one of your either your computer or your phone is still on. It still is not unmuted.
Yeah, I'm trying to shut it off.
Okay. No. Whew. Okay, maybe we're in business now. Okay, I'll keep going. So let's say, Paul, that in 10 years you went ahead and said, okay, I want to pay it off. And you know, you're going to be done with the loan and you're paying off the debt. You have already received your money because you received it in loan proceeds. Now, if you're having to pay capital gains in those 10 years, what you can do is say, okay, well, I'm going to go ahead. Let's say you still have some of that money sitting in the bank. I don't know, $800,000. And you pay off, you have the loan paid off. If you're going to be paying capital gains, you can turn around and take that 800,000, go and buy another property, invest it in something else to be able to justify that, yes, you've reinvested it and you don't need to pay the full 30 years or the full capital gains on that amount. But you didn't do it until 10 years later. So you're going to have the 10 years of taxes for that amount that's still remaining. You're going to pay those 10 years of taxes on the full amount, but then you can do a deduction based off of putting $800,000 into something at that point. And that's where you work with, so the team I work with includes, we have several referrals for tax advisors and attorneys, but I work with two people who are both, one person who's a attorney and tax advisor, and then another woman who's also a tax advisor. They're the two people that I have the seller conference call with because they can really help you to understand how to plan with your proceeds. So if you want to be able to do something like that, where you want to pay off the loan early because the loan is being in your name and is being paid by the intermediary buyer. But if you don't want it to be a 30-year loan and you want to pay it off early, they'll help you to plan for that and how to utilize your earlier received proceeds to invest them to then get a credit on your capital gains tax or to not be charged as much. Does that answer your question, Paul? Ooh, can't hear you.
How about now?
Okay, there you
Yes.
go.
Yes, it does.
Okay. Does anybody else need clarity or have any other questions on this process?
Well, let's talk about the interest rate. Like the intermediaries, if I'm not mistaken, would make, they'd be investing the money about 3-point-some%. Basically, in a sense, you are. And then your interest on the money that you borrowed, the 93%, is only like 3-point-something%. So it's kind of a wash, and you're paying interest only. And then do you know the requirements if you have to make every payment on time, or can you just kind of forget to and not really?
The seller doesn't make any payments. The intermediary does. And the way it's structured, and that's actually on the next slide with all the steps.
But what happens if the seller doesn't make his payments?
The seller doesn't make payments. The intermediary buyer is the only one who makes the payments.
Oh. But it's an unsecured loan.
Correct. And so that's a question of what about default? So if the intermediary buyer doesn't make a payment, the seller is not liable for any default.
Yeah, because there was a double close. He no longer has the property.
Exactly. There's nothing secured, and the person who's responsible for making the payments is the intermediary buyer. So the seller is not the one who's liable for the default. It's a big risk that the lender's taking, but the lender is earning a nice profit on their loan. And how it's structured is that the intermediary buyer invests their proceeds. So they invest their portion, and it's from their investments that they're earning a sizable return over that period of time that they're able to, that's where they make their money, and they're able to then ensure the payments of the loan.
They're selling paper is what they're doing.
They're selling paper. And so and as far as the interest rates, they do make a profit. I think that this buyer, he's got it written that he goes for investments of where the yield is 5%.
Is it all very, very secure though? Because, well, I guess, does the seller care anymore?
Seller doesn't care.
And that's the thing, is the seller doesn't really care. I mean, the seller's done. The seller's payments to the debt are being paid by the intermediary buyer. And there's no recourse that the lender has to the seller because the intermediary buyer on paper has made the agreements to make the payments.
Is there recourse from the IRS to the seller if it all falls apart and the money disappears?
No, because they've already received their payments. The seller already received their proceeds. So even if so when you, in terms of the constructive receipt of the loan being finally paid off, it's not, that doesn't occur until that occurs. The IRS has no concern of it. You know, your tax advisor is going to report, your tax attorney, your tax specialist is going to report every year that you didn't have any sale proceeds from that sale. It's just a line item that says that you sold it, but you didn't have any proceeds, and you still don't have any proceeds this year, and then this year, and that goes on for 30 years. So there's no tax liability until constructive receipt occurs. So the IRS is not going to say, oh, well, the loan isn't being paid. They don't, that's not even an issue, because they know that they can't charge tax against constructive receipt until constructive receipt occurs.
Mhm.
I just got a listing yesterday and the lady wants to do a 1031 exchange. Her profits are going to be about 800, maybe a little less.
Yeah. So she could benefit from it, because if it's 800 and let's say it's at the minimum 30% capital gains tax, she's going to be paying about 20, what is that? 240,000.
Yeah.
30%, yeah. So she'd be able to keep probably, I mean, if that's her net after sale, after expenses, seller costs.
I'm not sure, but let's say 600 to 800. But anyway, if it works out like that, I'll get you in touch.
Yeah, I mean, really, you are part of it because you're helping her as her listing agent. And these are the steps that I have on the screen here as far as, and this is very much a summary, but this is the process. You contact me, that's step one. I review the asset sale, the purchase agreement with you and your broker, or if I'm the one who's listing agent, I review it with you to see if it qualifies. And the qualifies means, what are your net proceeds? Is it the right kind of property? Is the property going to be able to sell? What's the market? Is it analyzed appropriately that you're going to be able to have the minimum proceeds, which is 500,000. And then I introduce you to the intermediary buyer, and that introduction is essentially, there's a portal where I go in and I put all the information in for the transaction, and then you receive a link to confirm that you're wanting to start a future sale transaction. You're not bound to it. And then the seller does. The seller goes in and confirms, and then the seller has to, and all of their advisors, so you as well, would review the executive summary, which explains the monetized, what's referred to in the tax code as a monetized installment sale. The tax treatment of the M453, which is what the code is, the 453 section of the tax code.
Let's say that again. That's 453, you said?
453. And it's a tax treatment statement that essentially says this is how the tax is treated.
Mhm.
And then there's a video that the intermediary buyer has prepared that really gives you a little bit more in depth of the process that I just went over. And I actually have a case study here I can show you in just a sec. So that's up to step 5. And then once the intermediary buyer has to approve the transaction, looking at everything to make sure that they can do this. And then if they approve it, then the seller sends to the intermediary buyer a copy of the sale contract and the title report. And in the sale contract, there has to be a cooperation clause that informs the buyer, Jesus in this case, that they are going to that the sellers may choose to engage in an intermediate sale. That language has to be there. And I have the clause for that, which I provide to, let's say in this case, Peter, to you. I provide that clause to you so that you can either put it in the contract, the purchase agreement that you have with Jesus, the buyer, so that you're in, or you do it as in the counter offer, where you put it on the counter offer, the SCO. You'll put that clause in there, as long as it's somewhere in an addendum, wherever. As long as that clause is in there, then we're covered in terms of allowing for the intermediate sale with escrow. And then the buyer will prepare, intermediate buyer will prepare an LOI, and that LOI is going to match your purchase and sale agreement. It's not going to change any of the terms, but they have to have something that shows they're making a purchase in this transaction of a double close. And then from there, everyone does a conference call, including seller's tax advisor and tax attorney. If they don't have that, they can work with our team who can help to advise them. That would be separate agreements with our team members. And then from there, the seller finalizes and signs the LOI. The lender then prepares the loan documents, and then the seller and advisors review that. And then the last step is, it's a 12-step program.
Make amends.
The last step is the close, where the intermediary buyer presents the transaction to escrow as a 1031, because they understand 1031. And then the transaction becomes an installment sale once closing is complete with Jesus. So those are the steps in a very much a summary way of explaining it. Any questions on that? Okay.
You've got to have a seller that's aware of this, or a seller's tax professional that's aware of this.
Right. So usually, like for high asset investors, they're going to have their CPA, they're going to have their attorney, and it's fine if they want to get involved. What my team prefers to do is they prefer to have at least our tax attorney and the tax specialist on the call with them, because not all tax specialists and not all attorneys get this. And they put up a ton of red flags because they don't get it. And it's that conversation between professionals helps them to understand it so that they can see the opportunity for the seller. Now, again, the seller's not bound to do this. The transaction, the confirming the future transaction where I have them go into the portal, that's just to present it to the intermediary buyer for consideration. The seller does not obligated in any way to do the transaction. They have to meet with their advisors to make sure everybody's in agreement. And then once everybody is in agreement, they can then move forward with the transaction. But again, that's the biggest piece of, the guy's name is Stan. He's doing these literally daily. He's doing these deals, the dealer. And he says that the biggest reason why they don't happen for sellers and why they don't happen that often is because the seller's advisors, their tax attorney or their attorney and their tax specialist are telling them no, because they don't get it. They don't understand the value of it.
Well, this is the third iteration of this type of process, and yours is the best one so far.
No, thanks.
Really? Okay.
Yeah, they're out there. They're certainly out there. This guy that I work with, he's been doing this for many years. He's a former attorney. He doesn't practice anymore. And he just decided to move into this space of doing installment sales because it just was it was a better way of investing. He does not provide any legal advice. He's a party to the transaction. He doesn't provide any tax advice. And he's very clear. It's interesting. A lot of his documents and a lot of his his resources are very much written with such detail, it's a bit exhaustive. It's not simple because he was a former attorney, but he is thorough, and his thoroughness and his specificity is really, I think, makes his offer here by one of the best that I've seen, because I researched it before I decided to move into this. And yeah, it is. I think he's one of the better ones out there. But there are others.
Yeah, the first one is a guy named Hershey, and the way he put it is like a third party holds your money for the 30 years, which just is a turnoff right from the beginning. The way you explained it was like, who gives a darn, because you got 93% of your money, and you didn't.
There's no default for you.
Yeah, and you didn't state it like the intermediary holds your money for 30 years. It was like, who cares? That doesn't exist. You just went away with 93%.
Right. Yeah. So 93% of your return versus, what did we say in your seller's example? If she's coming away, let's just use 600,000. If she's coming away with 600,000 net after expenses, and then of that, let's say 30% is going to go to taxes, which is 1,000. So now she's at 360,000. Does she want to have 360,000, or if 60,000 is her net, and it will be 93%, then
yeah, it's not good.
that's 500. Well, no, that's 558,000. So either she gets 360,000, or she gets 558,000. And that's the biggest piece, is when you, and I'm going to show you guys a case study right now. These are questions that people come up with. We'll go back to that in a second, but I want to show you a case study. Yeah, someone open it. Can you see my screen?
Yes.
You still see the presentation?
We see a Q&A.
Okay, let me see if you
Okay,
see.
Brad, you say you got to go? I guess he left.
Do you see the this now?
I do, yeah.
You see that it's a pre-tax sale? Or do you still see the presentation?
I think the pre-sale tax.
Perfect, okay. So this is an example of an apartment sale. It was $6.5 million sale of apartments. And of course, this is a case study. So the cost of the sale is 6%, net sale proceeds 6.1. The basis. So that's capital improvements, is what was the reduction. So they're basing the tax charge is going to be based on your proceeds less anything that you had to put into it in capital improvements. You know, you can take a depreciation. So capital gains, this is the taxable gain, 20% rate, excuse me. So there's your tax. And then they have a threshold if you're married. So your taxable amount, 5.26 at this tax rate. So then you have this added tax, because it's an income surtax. So your total taxes here, $2,063,000. Oh, total federal taxes due. And here's where that additional amount comes in. It's your depreciation recapture. So you had a $75,000 depreciation at a 25% tax rate. And then you had your California, your state taxes. So the state taxes were at 742, almost 743. So the total tax is this amount here. Now,
So this plan applies to state and federal tax.
right. Because you're going to, well, this is showing a deal, a standard sale with depreciation that you're taking, but you still have to pay tax on your depreciation recapture.
I guess what I'm really asking is, the state does the the state's going to want theirs immediately, or they'll wait the 30 years.
That is a good question for the tax advisor.
Yeah, I would think the state's going to want theirs immediately, but that's
There's no,
just,
there's no
I would-
tax on a loan proceed.
I would think so too, but then Mark just answered it. If you are not getting those proceeds, you are not paying the tax. You have no constructive receipt. So there's a difference between seller proceeds from sale and loan proceeds. The seller's getting loan proceeds and
okay. All right. So, okay, scroll down.
so without planning,
Background noise, Mark.
No, it's not me. It's not
Who's
me.
That was me.
Who's Kim Kramer on the call?
I'm in here. I'm using somebody else's phone because my
Oh.
internet is bad.
Kim, you have a really deep voice.
so now you have without planning, meaning without the installment sale, the standard. They're just breaking it down in a summary. Total net after-tax profit at close of escrow without it. With the installment sale, and they're referring to it here as planning because it was the tax specialist who put this together. You have it deferred for 30 years. And look this, there's your answer, Paul, federal and state.
Okay. All right.
5 million. So you're basically getting almost $2 million more in this scenario. And then they have a note here by coupling what they refer to, and this is how it's referred to in the tax code, monetized loan with an installment sale planning approach to sell the apartments. The seller defers the taxes for 30 years and receives 1.66285 more in projected tax-free cash available at close of escrow, representing a 50% increase over and above the amount that would have otherwise been received. So, I mean, this is a very basic, explanation, and you would receive, as the seller, receive a summary like this to show you your projected return at, your net proceeds at close compared to if you didn't do the installment sale.
Got it. Okay.
Okay. So any questions on that?
No, thank you for that. If that becomes a thing on you guys' sales, then reach out to Nina. I would think that that case study would probably, or how you did that breakdown right there, would probably be a valuable asset to show a prospective seller, so that they could make a decision. Their taxes now versus their taxes in the future. Okay.
So how much is the
And actually, I'll go one better than
intermediary?
that.
How much is the intermediary earning or charging? Or
That's I'll explain that in just a second. To answer to that, Paul, I actually have the calculator for my tax specialist to do a case study for the seller. So if you have a seller now who's ready, or if you're selling right now and you want to see what is it going to look like, I can calculator and give you one that's true to their deal.
Okay.
Yeah. Not
All right.
like they have to get a study. Yeah. To answer your question, Mark.
Give Mark a quick answer there, please.
Yep. The intermediary is investing their funds from the sale, what they earn from the sale. So they take their monies and invest it, and then what they're earning on their investment, they get a return, and a portion of that return is what they use to pay the installment loan, and a portion of that return is their actual net return.
so they're making something on a spread, I guess.
Yeah, exactly.
Okay.
All right, you guys. So I'm done.
Yeah,
Paul.
thanks for that. So I think let's do, thank you for that very much, Nina. That was good. Let's do this, guys. What do you say we get together on Thursday morning? We'll give it a couple of
Yes.
days, go about your business, do your thing. And I want you to do one thing. I want you to pick, one thing from that 30-day list, okay, that you can accomplish between now and Thursday. And then so report that on Thursday. Report your win on that on Thursday. whatever that was. For some of y'all had like a website and a logo and collateral material and email, whatever those things were. Pick one thing that you can accomplish between now and Thursday, accomplish it, and then you can report it. Okay? Deal?
Okay.
It's been a
Okay.
joy, and it will continue. I will talk to you guys on Thursday. Deal?
Have an awesome
Deal.
day.
All right. You guys have a great day.
Thank you, Nina.
Nina.
Thanks, Nina, very much.
Welcome, my pleasure.